Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Chaz Price. ARHQ.com is the website. The phone number, 419-794-3030. Don't forget, if you missed the first half of the show, you missed previous editions of the show, you just want to catch up on a certain segment, all the previous editions available for you on demand wherever you consume your media, YouTube, Apple Podcasts, Spotify. Just search for America's Retirement Headquarters. It's all there for you. Guys, a recent article from the Wall Street Journal echoes what we've all seen recently. The 60-40 portfolio mix, it's failing, and it's not just because of the riskier side of the portfolio. Both bonds and stocks have taken serious hits as of late. As interest rates continue to hold fast heading into 2024, should retirees and pre-retirees look at a different investment blend, whether it be a percentage or the actual investments within?
It is. I think this is an interesting environment that you have to navigate. And there's actually some really good things about today's environment versus in the past. You know, the term 60-40 has been something that's been around for a long time. And when you think about the term 60-40, what that generally means is you have 60% of your money allocated towards equities, and then you have 40% of the money allocated towards fixed income. And oftentimes we'll see this in like a 401k. So it's been very common and popular in the last 10 years that a lot of investors have gotten more involved into what is called a target date fund. So if you had like a target date retirement fund, or call it a target 2025, what that means is that fund is going to allocate more towards fixed income and less towards equities as you get closer to that retirement date. And in the world of 401ks or Wall Street terms, fixed income means bonds. The challenges we've been presenting on the radio show for the last couple of years is bonds have an interest rate risk. In fact, if we look at things like the aggregate bond index, symbol AGG, as the date of this recording, the aggregate bond index is really flat this year. So somebody could have 50 or 60% of their portfolio that's basically done nothing this year. While at the same time, as our previous segment pointed out, you have inflation running at 7, 8, 9%. You have the cost of dining out up 40% this year. You have the cost of automobiles or food at the grocery store. Things are getting more expensive. So when you have a big part of your portfolio that's not working for you, you're going backwards slowly. So the reasons why you want to look at things in a different perspective, it's not to say that 60-40 is not a bad concept. In fact, it could be a good concept. I believe in the fact of as you get older, you should be safer and simpler with your money. But the reality is because of how high interest rates are right now, you can replace some of the bond component of the portfolio, which is the riskier part, to things that are not interest sensitive. So you could have a high interest money market fund. And so as interest rates go up, the money market fund rates would go up. You could have things like an FDIC insured, and you could have that CD that would pay a fixed rate of interest for a set period of time. You can have a fixed annuity that would pay a fixed rate of return for a set period of time. I like replacing some of those riskier assets in the fixed income part right now and developing what is called a ladder portfolio. Having some money that's available for liquidity needs, things that you might need to cover living expenses over the next 6 to 12 months, laddering out a portfolio for 2 to 5 years. And so if interest rates continue to go up, you can ladder into higher interest rates, but not be in investments that are subject to risk if interest rates go up. When you're looking at the equity side, the article here in the Wall Street Journal, it's your set it and forget it 401k made you rich no more article. It also talks about the fact of how stocks are in, one of the most expensive times and valuations that they've been in. And, they've produced real annual returns, according to this article, during the following decade of just 2.7%. In fact, if you look at the Nobel Prize winning strategy of Dr. Robert Shiller and the Shiller PE ratio, right now the PE ratio of the S&P 500 index is 29.5, which is almost equal to where it was at before the crash of 1929. So on the equity side, I also think that you need to be really smart and intelligent what you own and know the reasons what you own. I love the philosophy of Warren Buffett here. We want to look towards owning cash-rich, low-debt, highly profitable companies that have a competitive advantage in this marketplace is, I'd say, how you want to have a sniper shot of approach. So again, the 60-40, at least in my opinion, Chaz, isn't necessarily dead. It's just a matter, again, knowing what that means to your portfolio and how to take a sniper shot approach and maximize where there's opportunities in this environment.
Yeah, I would agree. I think there definitely is a place in everybody's portfolio for something conservative and something fixed so that you can kind of build. It's almost like building a car. You need a chassis. You need some sort of reliability, some bit of comfort. But to Chris's point earlier, bonds have just been decimated over the last couple of years, and primarily it's because, in my opinion, of the rise in interest rates. And so, as I'm counseling with clients, that is definitely something that we're reducing your exposure to is bonds in general. And in exchange for money markets and other fixed investments, we have some options that don't have any interest rate and risk. Because the bigger issue that I see, Nolan, is the Treasury. We've talked about it ad nauseum. We've screamed it from the ceilings that the U.S. Treasury, there's a ton of debt that the government is going to have to reissue. In fact, according to the U.S. Treasury Department, the total amount of debt, marketable debt securities or treasuries, as of the end of September 2023 is about $24.2 trillion, and of which almost $9 trillion of it is coming due within the next 12 months. And so if you think about in any securities market, if I have a lot of it, and when we say reissue, that means the bonds are coming due. The government to finance the Treasury to finance the government needs to have us as Americans and participants in the global bond market buy that debt. They need our money to be able to finance, so they're issuing debt. Well, like any other market, if you have a ton of something and you dump it all on the market at once, it's going to really drop the price, and because there's just so much supply of it. And so the government, it's like doing surgery. And I think last week's market rally was a result of watching how intricately of a dance and a tightrope act that they have to deal with to try to issue enough debt to the market to not dump a ton of supply, choose where along that interest rate continuum they need to issue. Is it short? Is it long? It's a very difficult tightrope act that the Federal Reserve is walking right now. And so they did it very deftly, and they were positive, and that signaled that to the market that, okay, you're not going to dump a ton of Treasury debt on us. And so interest rates went down a little bit. But in my opinion, bonds are going to be underwater for quite some time as this trillions and trillions of dollars in Treasury debt keeps hitting the market. And as we buy, whenever there's a lot of something, it's just going to drop the price. So I wouldn't be owning a ton of bonds. If anything, the shorter duration bonds to me seem like a better fit. Although at some point, interest rates will go back down. So there is going to be a market, to lock in these great rates. So like you were saying, there's opportunity and then there's risk in everything. For savers, it's a great time to be locking in some pretty good longer-term interest rates. But for borrowers, mortgage rates, it's just going to be a very difficult time to be a bond owner. So no, the traditional 60-40 portfolio, as most investors know it, 60% stock, 40% bond, is not where I would want to be right now.
It may not necessarily be quote-unquote dead, but I'll put this in plant terms, not that I've got a green thumb, but it may need a little bit of a TLC to bring it back to life, a little bit of revisiting and changing around a little bit. The team at America's Retirement Headquarters can find what works best for you and how to revitalize that retirement strategy that you've got. That second opinion all starts with a phone call, 419-794-3030, or visiting them on the website, arhq.com.